A Bollinger Band is a technical analysis tool defined by a set of trend lines plotted 2 standard deviations positively and negatively away from a simple moving average, the SMA, 20 SMA in this instance, of a security's price, but which can be adjusted to any user's preferences. Welcome back everybody. I'm going to make a very quick and brief video for you about Bollinger Band trading, okay? And there's a lot of videos out there. Feel free to delve into them if you want all the technical jargon about this, that and the other. But generally, very briefly, this is what you need to know, okay? So in the center of the Bollinger Band we have a simple moving average. Specifically, it's the 20 simple moving average. So it's a short one, but obviously a lagging indicator, because all moving averages are in response to what's happened at the time. So they're always going to show you a smoothing out of a trend that's already occurring. So this is a daily chart. So what we see here is clearly, we'll just look at it from this perspective, okay? So the trend had already been up. 20 days later, the moving average decides to show us that the direction is now going to be to the up. So you can see that we have turned a corner, and now, because the price action has been up for this period of time, the center of the Bollinger Band, the simple moving average, has kicked in and has decided to tell us 20 days too late that the movement is to the up, okay? We have the upper band and the lower band, and this basically, within this upper band and lower band, is where 95%, and this is statistically accurate, 95% of all the price action will remain within the Bollinger Band. Now the Bollinger Bands move up and down because they surround the center of the simple 20 daily moving average. So knowing that there's only a 5% chance that we'll break outside of these, it would suggest to us that if we ever did break outside of it, we'll be pushed back into it. Now obviously, with some assets that's not the case. You can see what happens with some of these coins on Binance, for instance. Some of these altcoins, they just don't respect Bollinger Bands at all when FOMO kicks in or when fundamentals turn a corner. But generally speaking, they always get brought back in, and let's have a look at that now. So this is a daily chart. So we came out, a little tippy top there, we got brought back in, okay? Little tippy top, brought back in. Generally all these candles are being closed within the Bollinger Band, okay? So yeah, close, and then we came out, came back in, and this is one of those big moves that breaks the mold, okay? But you can see how the rejections take place. The gravity kicks in and brings us desperately back into the Bollinger Band. It has to be respected because it's the norm. There's no laws, obviously. This can be broken, and it does get broken quite often with altcoins. But what you'll generally see is that is generally the case. Now 65% of the time, if we're above or below, so let's just say in this case we're above, and we've remained above for quite a long time, so this is an inordinate amount of time, but generally speaking, when you're above or below the center of the moving average, you've got a 65% chance that you will remain within that. So breaking up from here, I would say that we're more likely to be supported on the if we came down to test it, because it's not a massive ratio, but 65% is still the majority. It only leaves for a 35% chance of a breakdown from here. So the odds are in your favor. If for instance, now we've had this uptrend on the simple moving average here, it's slowly uptrending. So breaking above here, the first place I would expect to support, unless you've done more research on the asset that you're trading. If you're trading just on Bollinger Bands, you're more likely to find a support on the center of the Bollinger Band, because the odds are in your favor. 65% of the time you'll be in that upper band. That's not always the case, because see, we break down beneath it, but we're generally closed above it. This kind of respected that law, I suppose. Like I say, it's not a law, it's just statistically what happens. The inverse of that is clearly possible, so let's have a look at this. So we go back to it here. So this, we spent an inordinate amount of time beneath the center of the Bollinger Band, so technically we were never really above it. It didn't exist back here because it was such a new asset. So we came in here and we stayed beneath it. Like I say, the vast majority of the time, if we were to come back up to test it, this would be where you'd want to sell. If you were lucky enough to buy anywhere and come back up to test it, you'd certainly be wanting to sell at the top. You would not be waiting for it to break above there, because you're only a 35% chance that it would and make its way above. Okay, you've got to use other indicators, other tools alongside the Bollinger Band to really get the edge. It's just one of many indicators that you can use. So, like I say, knowing that, so now we've got our heads around the fact that, yeah, it's a lagging indicator, so it's slow, but it's generally quite well respected. Everybody has access to it, so it's very popular, so everybody's looking at the same thing as you. They may not understand it, but you can recognize a simple pattern, which is it coming up and bouncing either on the center of the Bollinger Band or on the lower bands. Now, one thing is you will have noticed is that Bollinger Bands get smaller and wider, and that's to do with the price action, the volatility of it. So if we have big candle bodies moving up, stretching up above that, the Bollinger Band's going to have to expand to incorporate those candle bodies and wicks within it, because like I say, 95% of the price action remains within the Bollinger Band, so the Bollinger Band needs to expand to compensate for those breakouts. That means that if we were to break down, it means it's possible for it to come all the way back down again, because it's accounted for the volatility of the market. So we can come technically all the way back down to test this here. It was a much bigger move than it would have been within this little range here. As you can see, the Bollinger Band's contracting, getting tight, so the price action is very small. You might even argue that it's not worth trading in a sense. But one thing you can also say is, when Bollinger Bands start to pinch and get tight, that is usually a sign that a big move is going to take place. And you will often hear traders and people talking about Bollinger Bands saying, oh, they're pinching, they're getting tighter, they're pinching closer together, so something's going to happen soon. Because when there's no volatility or very low volatility, it means that something is going to happen. It's like a tectonic plate, alright? And they're just getting tighter and tighter and tighter and tighter, nothing's happening, and then suddenly there's an earthquake. And it's the same with Bollinger Bands. When they begin to pinch, it means that something big's going to happen. And the usual way, that one of the ways you can use the Bollinger Bands in that respect is, you've got to look for, because we have a lagging indicator, like I say, the 20 simple moving average, dictating but suggesting a certain trend. It will tell us which way that's going to go. So we'll look at this now and work that out. So like I say, we had this uptrend on this confirmed to us with the center of the Bollinger Band here, and like I say, that was 20 days too late because it's the 20 SMA. But from here onwards, it's been up, so it would be reasonable to assume that any pinch of the Bollinger Bands would mean that there's going to be a move to the up, because it continues to go up. The trend is continuing to go up, so the Bollinger Bands are pinching, meaning that it's very likely that there's going to be a big move. And because the simple moving average is going up, the big move is more likely to be to the up, especially if you remain above the center of the Bollinger Band. Remember, that's 65% chance that you'll stay above there, only 35% chance that you'll break down beneath it. So you can use the Bollinger Band in that respect, and as a tool on its own to just roughly get a very basic understanding and idea of where it's likely to go. But you really do need to use this in conjunction with lots of other things to you'll never confirm anything for certain, but to get more confirmation for yourself. But like I say, that is the basics of it. You have upper band, lower band, center, which is a simple moving average for 20 days. Staying above it is more likely to remain above it, beneath it more likely to remain beneath it and be rejected from here. Again, if you're above it, supported from here. Pinching of it with a moving indicator, so going up, more likely to remain up, and the volatility to be up. And if we go back in here, we'll see the inverse of that. Again, this is quite a volatile asset, so it's not the greatest, and TradingView has decided to go all weird on me now. But again, we've not had a great deal of it's just been pretty volatile all the way down from here, so there's not really a good example of that. But I suppose Bollinger Bands, you could say they began to pinch a little bit there, and the big move happened, and Bollinger Bands started to pinch here, and a big move happened, and again we were above there and the trend was up, so they were pinching up, and then obviously died from that. So it's like I say, it's one of many tools, but one of the most useful tools, and that is the general way to trade with it. And it's as simple as that. You have statistically more likely to break up if you remain above it, statistically more likely to break down if you're below it and the center of it is facing down. It's as simple as that, and that works for the daily, works for the 5-minute chart, it will work for any of these charts. They all follow the same law. So let's have a look at this. So just for fun, on the 5-minute chart, does it still work in the same way? Well, it certainly looks more volatile, but yes, it is respected in the same way, but it's certainly more volatile. Anyway, I'll leave it with you there. Just very brief, and like I say, it's not the most it's not the most in-depth video you'll ever find on Bollinger Bands, but that is the basics of it. There's no need to go crazy on knowing all the names and percentiles and technical jargon. That is how you use them. Anyway, thanks for watching. Hope you have a nice evening. Take it easy.